Welcome to The Explainer. Today, we are diving deep into a fascinating theory about a potential crisis that's quietly building up in the global silver market. Seriously, it's a story about a massive, truly unprecedented drain of physical metal from the world's most important vaults. And it has a lot of experts asking if a fatal flaw in the system is about to be exposed. This analogy from our source material just perfectly nails how strange this situation is. Think about it. 4 feet of snow in Death Valley in the middle of July. We're not talking about some minor market blip here. This is something that, by all accounts, just isn't supposed to happen. It's completely defying all the historical norms. So what exactly is this snow in the desert? Well, it all boils down to a massive physical movement of silver, a drain from the very vaults that are supposed to backstop and guarantee the stability of the entire market. Get this. Since last October, nearly 90 million ounces of physical silver have been yanked out of the COMEX exchange vaults. I mean, just to wrap your head around that, that is an enormous amount of real, tangible metal being taken out of the system. And it's happening at a speed we've literally never seen before. And this is a huge deal because it represents a fundamental shift in behavior. For decades, the silver market has been all about paper contracts, basically IOUs for silver. But now you have these major players stepping up and saying, you know what, we don't want the promise anymore, we want the actual metal. They're standing for delivery. To really get why this shift is so critical, we need to talk about the massive disconnect between the world of paper silver and the world of physical silver. They're two completely different beasts, and right now it looks like they're on a collision course. It all starts with this really complex financial term called rehypothecation. But let's break it down. In simple terms, it lets the very same bar of silver that's sitting in a vault be leased out, sold, and used as collateral over and over and over again. What you end up with is a mountain of paper claims all sitting on top of a tiny little pile of actual metal. And the scale of this is it's mind-boggling. According to the source, in the London market, the leverage could be as high as 500 paper claims for every single ounce of physical silver that's actually available for delivery. The whole system is built on one big assumption, that everybody won't show up and ask for their silver at the same time. So the core conflict is pretty simple, right? The paper market is practically infinite. You can just print as many contracts as you want. But the physical market, it's finite. You can't print more silver. One is just a promise. The other is cold, hard reality. And the big, scary risk in that paper market is counterparty default, the chance that the other side simply can't make good on their promise. All right, so who's actually doing this? Who's behind this unprecedented demand? It's not a bunch of small-time investors, I can tell you that. We're talking about some of the biggest players on the entire global stage. The demand seems to be coming from 3 really distinct and powerful groups. First up, you've got industrial titans. Think Apple, Samsung, Tesla, companies that absolutely need silver for everything from iPhones to solar panels. They might be trying to lock down their physical supply chains in a pretty unstable world. Second, you have massive investment firms, big money looking for tangible assets to protect them from things like inflation. And third, and this is where it gets really geopolitical, you might have sovereign nations, countries strategically draining physical metal to really test the limits of the system. And hey, by the way, if you're finding this explainer valuable, please take a second to like, share, and subscribe so you don't miss any of our updates. It really does help us out a ton. So how does simply asking for the metal that you're owed, how does that become a potential weapon against the entire financial system? Well, it all comes down to exploiting a fundamental weakness that, for years, pretty much everyone has overlooked. Our source material brings up another fantastic analogy, the fatal flaw in the Death Star. The whole futures market only works if delivery is actually possible. But nobody ever really thought that massive coordinated players would use that exact delivery mechanism to stress the system right to its breaking point. Well, until now, that is. What this creates is a powerful chain reaction. It's called a short squeeze. It all starts when a big player forces a bank that has bet against the price of silver, that's a short position, to actually deliver the physical metal. Now that bank has to scramble to buy real silver on the open market, which of course drives the price up. That in turn forces other banks in the same boat to start buying. And you can see how this could create a massive price explosion. And for the institutions holding these massive short positions, the financial stakes are they're astronomical. I mean, a relatively small move in the price of silver could translate into billions with a B of dollars in losses. Okay, but why should this matter to anyone who isn't directly playing in the silver market? Well, according to the theory we're exploring today, this isn't just about a single commodity. This could be about the very foundation of the financial system itself. And this leads us to the absolute central question of this whole story. Why have a handful of Western banks held the single largest, most concentrated bet against an asset in the entire history of commodity trading? It's a huge, coordinated risk. Why would they take it? The theory goes that precious metals like silver and gold are the ultimate counterpoint to paper money. So, by actively keeping the price of silver down, these institutions help maintain confidence and faith in the current dollar-based system. A rising silver price, from this point of view, is basically a vote of no confidence in the dollar.
So this leaves us with two competing theories. On one hand, you have the straightforward financial explanation. This is just a long-term strategy to control the market and make a profit. Nothing more. But then you have this more provocative geopolitical theory that suggests this could be a targeted strike, using the market's own rules to intentionally weaken major Western financial powers.
And this, right here, is the core risk. We're not talking about isolated commodity desks. These are massive global banks that, as the source says, have their fingers in every pie. A failure to deliver silver doesn't just stay in the silver market. It could trigger a crisis of confidence that ripples through the entire, deeply interconnected financial world. So we're left with this final, really critical question. In a system built on a mountain of paper promises, what happens when someone is finally forced to show their cards and they can't deliver the real thing? What happens to the whole ecosystem when that very first domino falls? It's a question that we may actually see answered sooner rather than later.